bonds. Now, to be clear, these are not the same things at all.
Do you think, KR, that the customers care?
In none of the cases they do. They just want their money back.
Silvergate and Signature Bank were well known in the crypto space, while Silicon Valley Bank was massive in the tech startup world. However, despite their differences, these banks failed for similar reasons at a high level, which is this. They all experienced a run on the banks when too many people demand too much money too fast, and the banks don't have cash on hand. Now, I want to make something clear. It would be easy to draw the comparison to the crypto crash in 2022 when several crypto companies like FTX collapsed, but there's an important difference. Companies like FTX were insolvent. When there was a run on their banks, they had no money to give. Whereas the banks we're talking about were illiquid, meaning they had the money, but when they had the bank run, some of it was locked up in long-term assets like bonds. Now, to be clear, these are not the same things at all.
Do you think, KR, that the customers care?
In none of the cases they do. They just want their money back. They just want their money back.
You think the customers care? I mean, the difference is it is important to
It's important, yeah.
because they have the money, but maybe they have it in what's it like, long-term deposits, right? CDs and
Yeah, they have it in long-term assets, so they cannot pull it out without losing themselves.
So,
but yeah, I mean, at the end of the day,
no, continue.
At the end of the day, it's a difference, but it boils down to the same stuff. You're not getting your money.
Yeah, we have it.
Worse, even worse, because I think the biggest difference between FTX and SVB or any other bank is banks are still in the monetary coup. So there's a kind of an umbrella that can save a fraction of the money if the bank goes down. Now for FTX, they were basically off on the Bahamas. So yeah, you lose your money, you lose everything.
Yeah.
Because they're not under that umbrella.
Yeah. I think one thing you mentioned, that's why they are, and we talked about this in a previous show, why they're thinking or proponents of there are proponents for putting the crypto, so creating crypto that falls within the monetary system as well.
Yep.
That can be controlled, that it's a centralized, right? So it's centralized crypto with a bank or some sort of institution to safeguard it. But basically, if you do that, then there wouldn't be much of a difference between crypto and
regular money. That's the whole thing about crypto, right?
Yeah,
that's the whole thing that the people are pro crypto. That's what they're banking on. So
yeah,
having money not in the current monetary system but outside of it without But yeah, let's continue.
But things can get a little fuzzy in the details. For example, when a bank run happens, what can start as a liquidity problem can become an insolvency problem if the bank has to sell what they have for cash. And let me explain. One of the safest investments is considered to be treasury bonds. Your grandparents probably invest in it. Banks invest in them, both for the same reason. They provide a stable rate of return. So say you're Signature Bank, right? You've got billions of dollars in customer assets. Where do you put it? Well, into treasury bonds, which let's say earn you 1% a year. You keep some cash on hand for withdrawals, but you figure, look, If I need to sell these, I can sell my bonds, right? But what happens if interest rates rise really quickly? Well, suddenly you have this 5-year bond you bought a year ago, which gives you 1% a year. But now the government is selling the same 5-year bond and offering 5%. Because of that, now your bond's value on the open market drops. It's no longer even worth what you paid for it because it's giving less interest than other bonds. And so if you try to sell that, well, now you lose money. Now, to be clear, if you held the bond to maturity, well, you would still make that 1% and not lose anything. But when depositors are asking for cash, it's simply not an option to hold on. Now, I know that seems complicated, but the essence of it.
Well, I don't know if it's complicated. He explained it pretty simple and pretty clear how it all goes down.
Yeah, but I think what he meant to say was that the so the theory is much simpler than the practice. I think that's what he was
This
alluding to.
explanation is a bit
Straightforward, very straightforward, but in
Not that.
practice, yeah.
Maybe I'm used to the complicated one.